on Business Incorporated today. Egypt to hike fuel prices in a couple of days. Ghana household spending drops by 11%. And Zimbabwe half-year loan jumps by more than 100%. Good afternoon. Welcome to Business Incorporated here on Channels Television. I'm Ini John Mekwa. Well, let's dive right into the program with market numbers. We look at Nigeria's equity. Seems like it has lost that bull run, at least for intraday. It was down marginally, though, 0.02%. And hopefully it will recover before the close of trade. South Africa, Jersey, also down, same, very marginal there, 0.03%. For South Africa, looking red there. Then we move over to other parts of Africa. Egypt is doing really good, almost 2% in the positive. A very hard bull run there at 16,904.18. Kenya also closed positive yesterday, 0.08%. We move over to the Middle East now, where sentiments were mostly negative at intraday. Abu Dhabi in the negative 0.02%. This is following yesterday's sentiment that it closed with. Dubai also negative. There we see the numbers there, 0.19% at 3,395.69. Looking at other regions are still there. Saudi Arabia still in the negative, more than 0.5%. Qatar had it even worse, more than 1%, 1.30% down to intraday at 10,571.91. We move over now to Europe and have our correspondent Chris join us there. And what we're talking about this afternoon is a recent drop in sales, which shows how strongly electromobility in Germany still relies on government subsidies and some financial incentives dialed back at the start of the year. The latest sales figures show that there's been a disappointment for the industry, which now is pondering on how to find buyers for still relatively high-priced electric cars. We do know that this energy transition comes at a price. Well, Chris, tell us more about this. How have car sales been developing lately in the face of this subsidies?
They took quite a hit last month. January sales were down more than 2.5% compared to 1 year ago. The decline comes after a bumper month in December when customers rushed to make the most of purchase bonuses and subsidies for e-cars before incentives ran out or became less attractive from January 1st onwards. And these changes to incentives are quite substantial. Since the beginning of the year, only fully electric cars continue to receive any subsidies. Hybrids don't. The amount of money with which the state is supporting buyers is also smaller, down from 6,000 to 4,000 euros for a car that costs more than 40,000. For cars that cost less, the financial incentive has also been dialed back. And that shows in these statistics, whereas 1 in 2 cars sold in December were either fully electric or hybrid, just 15% were in January, amounting to around 27,000 vehicles, meaning that the relatively high price for e-cars compared to vehicles with a combustion engine is shifting into focus again. The average price for a new car in Germany stands at more than 41,000 euros, and that's up more than 14,000 from around 10 years ago. And the average price for a battery-powered vehicle stands at almost 43,000 euros, and that is too much for many families. And an environment of rising prices and declining purchasing power is doing its part to raise this concern among customers as well.
So if pricing is such an issue for consumers, do we know what manufacturers intend to do about it?
They are recycling a trend last seen during the financial crisis. They're downsizing their cars. Less weight means a smaller and cheaper battery without compromising on range, and less speed means an engine with less power, which again results in a smaller battery and less weight and lower costs. Now, take French producer Citroën, for example, which just recently unveiled a concept car 4 meters long, seating 4 passengers, with a €25,000 price tag, which meant that drivers had to be satisfied with a top speed of 110 kilometers per hour and a range of 400 kilometers. Other big brands like Renault or Volkswagen apparently are working on their version of downsized e-cars, and the price of €25,000 seems to be somewhat of the limit here.
So let's leave that on one side and take a look at the market. How's that doing at this time?
Well, it was a somber start to the week with geopolitical concerns mounting as the U.S. and China are at loggerheads over a suspected Chinese spy balloon floating across the U.S. for days. And then there was Friday's blowout U.S. jobs report, which has investors scratching their heads over what the U.S. Federal Reserve is going to do next regarding interest rates. A red-hot U.S. labor market could be the indicator of an extended period of high borrowing costs right after Fed Chair Jerome Powell sent less hawkish signals about future interest rate hikes after acknowledging progress in the battle on inflation. All of that is likely to be a topic of a speech the chairman of the Federal Reserve is delivering today. Analysts and investors will be listening closely there. Before that, German stocks are trading slightly lower. The DAX in Frankfurt retreating 0.3% in the early parts of today's trading session.
Oh, thank you so much, Chris. That wait starts again, and it's affecting all markets. For instance, in Asia, stocks are traded mixed on Tuesday as investors digested the Reserve Bank of Australia's interest rate hike of 25 basis points, broadly in line with expectations. The S&P 200 fell. Let's look at some other numbers there. We have the Nikkei 225 in the red at 0.03%. That's marginal, 27,685.47. The Shanghai Composite in the green, 0.29% up. Hang Seng also in the green. The Kospi in the green. And then, of course, you have that Australia after that rate hike in the red at 0.46%, almost 0.5% there. The Australian dollar also strengthened 0.67% to last trade at 0.69 against the US dollar. South Korea's Kosdaq led the gains in the region and rose by 1.51% at 772.79, while the benchmark Kospi inched up 0.55% to close at 2,451.71. In Japan, there we have the numbers there. The Nikkei 225 are looking not so good in the red. We move to the United States now, where stock futures rose marginally on Tuesday as investors brace for the latest commentary, which is due today from Federal Reserve Chairman Jerome Powell. As Chris mentioned there, futures tied to the S&P 500 were up just 0.2%. Futures connected to Dow Jones Industrial Average also inched up 0.02%. Nasdaq 100 futures advanced 0.35%. On the earnings front, PIN interest shares fell 3% in the pre-market on the revenue miss and a weak outlook, while Cheng plummeted more than 23% on disappointing guardians. Those overnight moves followed another down session for markets as bond yields rose and pressured growth stocks for the day. The oil space now, prices rose for a second straight session on Tuesday, driven by optimism about recovering demand in China and concerns over supply shortage following that shutdown of a major export terminal after an earthquake in Turkey. Brent crude futures rose 82 cents to $81.81 a barrel, while West Texas Intermediate crude futures was up 82 cents also to $74.93 a barrel. The International Energy Agency, the IEA, expects half of this year's global oil demand growth to come from China. Saudi Arabia, the world's top oil exporter, raised prices for its flagship crude for Asian buyers for the first time in 6 months amid expectations of oil demand recovery, especially from China. Operations at Turkey's 1 million barrel per day oil export terminal were halted after that major earthquake hit the region. The BTC terminal, which exports Azeri crude oil to international markets, will be closed from the 6th to the 8th of February. Metals now, gold prices rose on Tuesday as the dollar pulled back slightly, with traders awaiting U.S. Federal Reserve Chair Jerome Powell's speech again on later on today, looking out for hints about the future rate hikes after last week's strong economic data. Spot gold was 0.3% higher at 1,872.59 per ounce after hitting its lowest since the 6th of last month. In the previous session, U.S. gold futures rose 0.3% to $1,886.50. Gold prices had shot over the $1,900 an ounce threshold in January on hopes of slower Fed rate hikes, but prices have since retreated. Market participants will be keenly watching that Powell's speech to see if it turns hawkish after last week's stunning jobs data. Well, let's go to Egypt now, where the country has been applying a quarterly price index mechanism on all petroleum products since the beginning of full year 2019-2020 in light of global oil prices and the US dollar prices against the Egyptian pound in a range of plus or minus 10%. The FAPC has held regularly meeting at the beginning of each quarter since then to announce price changes. It's been observed that the committee held its quarterly meeting as scheduled in January and drafted its non-committal recommendations regarding fuel prices movement. Yet, the government decided not to announce the meeting outcomes at the time to avoid negative feedback from local market. The Egyptian pound's performance is currently at its lowest against the US dollar, losing over 100% of its rate compared to March 2022's level. The US dollar is trading for over 30 Egyptian pound as we speak. And the committee said in its report that the just price of fuels in the local market in the current phase is about 18 Egyptian pounds per litre in light of oil and gas prices hikes globally and the global inflationary wave. Consequently, the country is expected to hike prices in a couple of days. While staying in Egypt, trade exchange value between Egypt and Croatia has increased by almost 91% to reach $203.9 million during the first 10 months of 2022. Egyptian Central Agency for Public Mobilization and Statistics showed the data that imports and exports value recorded about $107.8 million during the first 10 months of 2022 compared to $26.6 million in the same period the year before. The top Egyptian exports to Croatia are fuel, mineral oils, and distillation products with a value of $57.5 million. Plastic products also makes up that list, $14.7 million, and garments with a value of $13.4 million. Let's take a break now. After that, we'll head to commodity space. And of course, we do have more stories from the African continent. So stay with us. This is Business Incorporated on Channels Television. Welcome back to watching Business Incorporated here on Channels Television. We can't seem to talk enough about the impacts of the Russia-Ukraine war disrupting commodity markets globally and including sugar. Did you know that Russia is the 8th largest producer of sugar in the world? So we can expect that that space has also been disrupted. So we've seen that prices of sugar have increased by 8.25% to about $21.64 year to date. the 6.75% sin tax on non-alcoholic beverages has reduced demand for sugar globally due to its harmful effects on health. But how is all this affecting the production of sugar and also the profitability? Do we have other countries cashing in on this? We have joining us for this conversation analyst from financial derivatives company, Adeye Adegusi, joins us virtually. Hi, Adeye, good afternoon. Good afternoon, Adeye.
Thanks for having me.
Yeah, good to have you. So, how do you see all of this? Russia is still very busy, with the war. We have that sin tax, which is supposed to discourage the consumption of sugar, at least sugar-based products. How is that affecting the sugar production, sugar profitability? Also remembering that in Nigeria, there's that sugar master plan, that is supposed to bring, I think, backward integration into that space. How is all of this affecting production and profitability of sugar?
So there are two sides of this. On one hand, industrial demand is increasing due to higher oil prices. On the other hand, the sin tax, the increased awareness of the negative effects of sugar has reduced household demand. Let's start from the industrial demand. In 2022, oil prices soared to multi-year highs, trading over $100 per barrel for the first time in years. And this has led to a shift in the use of oil. Now, people use sugarcane to produce ethanol. So that has raised the demand. Now, on the other hand, the increased awareness of the negative effects of sugar on health has led to a reduction of demand from households because people in their diets, people use less sugar. This led to the adoption of the sin tax, 6.75% tax, which translates to about 10 naira per liter of sweet beverages. So now, study shows that people that consume more carbonated drinks are 20% more likely to get diseases like obesity, type 2 diabetes, amongst others. So in view of this, the sin tax, the 6.75 sin tax, the increased awareness, the lower household consumption, and the higher demand to produce ethanol, then when you come to balance it out, there's also I forgot to mention also soft drink consumption in Nigeria is also expected to grow by 5% from 2023 to 2028. Now, in view of this, sugar production is still going to remain profitable in Nigeria and globally because of higher demand for the production of ethanol and higher soft drink consumption by individuals.
All right. So in Nigeria, the country has the potential to produce about 1.7 million metric tons every year. In spite of this, Nigeria still imports about 93% of what it consumes. Now, we have a country like Gabon that has been able to cut its sugar import by about 50%. What lessons can Nigeria learn from countries like Gabon?
In the third quarter of 2022, Nigeria spent about 83 billion naira on sugar imports. Now, looking at a country like Gabon, similar in terms of oil production, they have managed to slash their sugar imports. From 2020 to 2021, they cut it by about 44%. That's to 4,000 metric tons from 7,000 metric tons in the previous year. What have they done? The sugar regulatory body in Gabon, SUCAF Gabon, they were allocated about 30,000 hectares of land just to produce sugar for exports. And also, they spend about $2.8 million a year on sugar production, not just to meet local demand, but also for exports. And now, even looking at other West African countries, when Nigeria only produces 3%, 7% to meet our local demand, countries like Ivory Coast, their production meets about 63%, Senegal 50%, Burkina Faso 47%. And as you said earlier, the Nigeria Sugar Master Plan, implemented in 2013, has four main objectives: to increase production, reduce importation, increase employment opportunities in the sector, and also produce enough to be able to make ethanol for electricity generation. Yes. And also, it also has the objective of making Nigeria the largest African producer. Although it might seem like a stretch, it's a gradual process. The second phase is about to start, starting this year. It's a gradual, and as I said, it's a gradual process. So you can go from meeting 10% of our demand, 20%, 30%, 40%. So, but in general, the outlook for the Nigerian sugar industry looks good, and we expect to produce more to meet local demand, to reduce our import bill.
So would you say that we're on the path now of this, learning the lessons from countries like Gabon and the other ones that you mentioned, and also cutting this 93% of imports? Would you say we are on our way cutting that, at least for this year, 2023?
Well, 2023 is possible, not fully cutting, not fully attaining the objective, but then reducing the imports maybe from 93%, not 93% of imports, to about 80 to 85, depending on how things go in the market, and of course agriculture is subject to weather conditions. So we'll see along the year how it goes.
All right, Adeye Adebusi, thank you so much for sharing your thoughts with us, analyst with Financial Derivatives Company, this afternoon. Enjoy the rest of your day.
Thank you.
Let's move to Ghana now. Total household spending in Ghana reduced by a high margin of 11.09% in 2022. The fourth edition of UK-Ghana Chamber of Commerce Annual Ghana Business Environment and Competitive Survey has revealed. This, the research says, could be a result of inflationary hikes experienced in the country. Analysts believe that the imposition of a 1.5% e-levy and the weakening of the currency in 2022 affected the total spending. A decline in disposable income in 2022 also affected total spending. However, the number of households increased in 2022 amidst the high cost of living. According to the survey, the number of households is expected to continue increasing beyond 2025. In Zimbabwe, loans and advances from the banks to various sectors of the economy increased by 114.46%, and it hit $1.28 trillion in the 6 months to December 31st, 2022. And that's according to the Reserve Bank of Zimbabwe. As a sharp increase in foreign currency account balances in the banking system and marked growth in external credit lines drove the US-denominated loans, which accounted for 78.2% of total loans during the second half of the year. As a result, the level of financial intermediation as measured by total loans to total deposit ratio improved from 52.83% recorded in June to 55.67% recorded in December 2022. And in Kenya, sole power distributor Kenya Power aims to convert its 2,000 petrol and diesel-driven vehicles to electric over the next 4 years. The move is part of a rising trend in the East African economy to take advantage of the abundant electricity supply from renewable sources and switch vehicle and motorcycle engines to electric from fossil fuels. Kenya Power will phase out its petrol and diesel vehicles by retrofitting electric engines and buying new electric vehicles. Kenya has installed generation capacity of 3,321 megawatts against the peak demand of 2,132 megawatts and off-peak demand of about 1,100 megawatts. Well, it looks like Kenya should send some of those electricity to Nigeria now. Well, finally on the program, we head to Cote d'Ivoire, where sector concerns have been raised in the wake of a new industry study on transparency and traceability of cocoa supply chains in the country, revealing that only 45% of crops can be tracked back to original buyer. The research from IOP Publishing, part of the Institute of Physics, reportedly found that the remaining 55% of cocoa in the country cannot be tracked, as it's reportedly indirectly sourced by traders from intermediaries or exported by groups that disclose no information about their sourcing. As previously reported by Confectionery Production, the Côte d'Ivoire, as with a neighboring Ghana, has also faced significant problems with illegal mining, known regionally as galamsey, which has further impacted on the potential for progress within the cocoa sector. Moreover, IOP notes that in response to public pressure, many chocolate companies have made investments in tracing the origins of their cocoa supplies, committing to zero deforestation policies. However, it's asserted the success of these initiatives have been limited. In its view, this was because of often a breakdown of records between the cocoa production and its transportation. This makes it difficult to assess where companies source their cocoa and what progress they are making toward their zero deforestation pledges. Big question there on where does the cocoa come from? If you don't know the source, how do you know the style, the health of what you are consuming? Well, questions to be answered on other episodes of Business Incorporated. Thank you so much for being a part of today's episode. I'm Minnie John McCoy. Enjoy the rest of your day.